The Consumer Price Index is going to be released today. More inflation, more problem. You know, I mentioned here a moment ago, I was talking to a banker yesterday. I said, what are the mortgage rates at? I thought they'd been going down. Wrong. 7.5%. He said they just went up again. So there's more pain for somebody who's trying to get into their first house, try to build some equity and some wealth. It's just not going particularly well. Terry Sawchuk is the founder of Sawchuk Wealth. He has some ideas on how to protect yourself. Terry, good morning.
Morning, Steve. How are you, buddy?
I'm doing well, my friend. So the CPI, the Consumer Price Index. Look, is it getting better? Is it getting worse? Where is it? In a week's time, Donald Trump will be back at the White House, and things are going to change as to how we approach the economy, I think. What does it mean today?
Well, rates are certainly climbing, as you noticed with the mortgage rates. 10-year Treasury's up to 4.75% now. You know, it's higher than it was in the banking crisis back in March of 2023, right? So this is definitely not great for the economy, and it's why the stock market has been having some problems lately, because there's a pretty much direct correlation right now between interest rate expectations and what the stock market's been doing.
So there you go. So again, what are mortgage rates going to be 8%? I mean, 8.5%. I mean, where are we going with this? I mean, look, Trump can turn things around, but it doesn't happen instantly.
Well, and the reality for now is that he has no impact on short-term interest rates because that's set by the Fed. And listen, it is no secret that Powell and Trump don't get along. I mean, the Project Veritas report that came out showed, I mean, the guy on the inside of the Fed said they actively worked to undermine Trump's policies in the first term. So I'm not sure how this is going to play out. The data currently is a little bit warm, and the inflation numbers are starting to creep back up a little bit. Today's CPI will be important. If the CPI number comes in at or below expectations, it should put a stop, at least on a short-term basis, to this rise up in interest rates. But if the number comes in a little hot, these numbers are just going to keep going higher.
All right. Well, that's not good news, not for consumers, not if you have credit card debt or an adjustable rate mortgage. People still have those, right? Or, whatever debt you might have. I was thinking about this today. We were talking about the wildfires in California again. And I'm thinking, how horrible. If you weren't prepared for a wildfire, if you didn't have insurance, a lot of insurance companies got out of California. Reason being Prop 103 that basically allowed the government there to set the rates they're allowed to charge and demand what they have to pay. In fact, they're trying to backdate now. There's a law in California. You cannot leave an insurance policy midterm. If people are making their payments and making their premium payments, you can't cancel an insurance policy partway through. They're trying to make that retroactive. I don't think that's going to be legal because California wants to stick it to the insurance companies and not their own mismanagement. I mean, this is risk management 101, isn't it?
You can't buy fire insurance after your house is already right. Same thing with your investments. You have to put the risk management in place before before the market falls. So it's really critical that you're able to manage risk and understand, like, how did you get here, right? And then what can you do to protect your portfolio, or in this case, buy homeowners insurance.
Yeah, so many things going on. We expected all these rate cuts this year. That's not happening, obviously. At least I don't see that happening because the inflation rate's going to be higher. Risk management. People get to a point in their life, my age, right? We're trying to figure out how to collect and hang on to what we've got without being exposed. And you wonder, was your advisor good or lucky over the last couple of years? I mean, honestly, it's a question people ask, isn't it?
Yeah, I think over the last couple of years, making money's been relatively easy because every dip got bought right back up, and the Fed came in and, they bailed things out. So from the standpoint of, risk management, I think now it's really important that you have things in place to protect your portfolio because the low-hanging fruit's already been picked, and I think it's going to be difficult on Trump in the beginning. There's people that are working against him, and so I think the market's got. We might get out of this one if the CPI number, like I said, comes out okay. It could put a temporary reprieve on the falling of the market, but I think 2025 brings a lot of downside risk.
Yeah, well, we'll find out because historically speaking, we've had two big years in a row, 23 and 24. Historically speaking, the third year will still be good, but not as good. But we've also had years where that third year the bottom falls out. So. Look, I just work here, and I'm just trying to save a few peanuts for winter, that's all. Anyhow, you've got an idea, by the way. your America First Built to Last wealth management system. You're going to be sharing it with folks here. We put it up on the screen. If you got a smartphone, you can scan that QR code. Terry, what is this all about?
Well, we designed, wealth management system for people that have conservative values and that believe in putting America first. And we've got a better business model. I mean, the reality for us is that our costs are lower, yet our margins are still, better than most advisors, which allows us to deliver a whole lot more for people's money than what a typical advisor would. And I would say of all the things that are on that screen right now, the disciplined risk management is the most important part. If people are trying to use diversification as their backstop, to help kind of mitigate some of the downside risk as we go through these changes, you might be in for a rude awakening, because the reality is, as interest rates climb and the dollar strengthens, both stocks and bonds typically have problems. And so you need to understand where to go to protect your portfolio, or put other measures in place like hedges to make sure that if the markets get volatile and we get a 20 or 30% decline, that you're not going to take a huge haircut.
Yeah, take another big hit, because, look, again, if you get to my age, you don't want to take a haircut because you don't have that much time to respond. All right, where do people find out more about this?
You know what, Steve? All they have to do is go to sawchukwealth.com/Gruber. Does that name sound familiar?
How convenient. How convenient. Yeah, it does. That's it. Sawchukwealth.com/Gruber. You can find out more. Built to last. America first, and 6 days to go.
By the way, you don't have to worry about haircuts. You got plenty. You're good.
Well, thank you. Greatly appreciate that. Yeah. Well, thank you. Thank you very much. Real quickly, we got about 10 seconds. Are you optimistic about 25 with Donald Trump in the White House?
I think it's the best thing that could have happened to America. It might be bumpy, Steve. We might have some turbulence. And 2025 might be a rough year, but beyond, it's going to be awesome.
Best thing that could happen. Terry Sawchuk, thank you very much. Sawchukwealth.com. Check it out, /Gruber, of course. Thanks, Terry. Greatly appreciate you.